My name is Satoshi Kono, Executive Vice President of Raccoon Holdings, Inc. Thank you for gathering here today in such large numbers to attend the financial results presentation for the first quarter of the fiscal year ending April 2025. The summary of financial results was released earlier today at 3 p.m., so allow me to use this opportunity to dig a little deeper into the results and offer more information. We have identified a number of key points, the first being a very strong start for both the EC and financial businesses in the 3-month period corresponding to the first quarter. Point number 2 pertains to the EC business, within which we operate our super delivery website. In the first quarter, Raccoon recorded double-digit growth in super delivery GMV, gross merchandise value, in both the domestic and overseas markets, marking a very solid start to the April 2025 fiscal year. In terms of the specifics, domestic market GMV stood at 4.816 billion yen, for a YOY increase of 11.4%. Overseas results exceeded our expectations, as we recorded an international GMV of 1.882 billion yen, for a YOY increase of 19.2%. All in all, the EC business achieved super delivery GMV numbers of 6.698 billion yen, for a YOY increase of 13.5%. This therefore represents a strong start in line with company forecasts. As you can see from the vertical bar graph on the right, the super delivery business is affected by seasonal factors and generally tends to see a gradual upward progression in GMV starting in the first quarter and peaking in the fourth quarter. We then tend to see a quarter-on-quarter GMV contraction in Q1, but this wasn't the case this year, as super delivery has posted a rather robust results performance. To reiterate, whereas normally we would see a GMV contraction in Q1, GMV kept pace with and actually slightly exceeded Q4 results by 0.2%. In particular, last fiscal year, on the domestic front, we revised the plans we offer to our members and enhanced our sales promotion offerings, and these efforts led to a YOY increase of 31% in the number of buying customers, which drove the aforementioned growth in GMV. As such, while the value of transactions per customer remains low, more buyers have made it possible to raise GMV results. In terms of the international market, we recorded very strong results in the US and South Korea, and this trend has continued into the ongoing fiscal year as well, thanks to growth in the number of buying customers in these two markets. More specifically, the number of buying customers increased by 32% in the US and by 106% in South Korea, and this translated into very significant GMV increases of 41% for the US and 67% for South Korea. Another important development was a return to a growth trend in Taiwan after 2 consecutive years of GMV contraction. In fact, our operations in Taiwan had been weighing down somewhat on overall GMV results in the international market, but starting in Q4, we had been seeing signs of a recovery. GMV was up 13.3% in the first quarter and 8.8% on a QOQ basis, underscoring a return to a growth trend, and this has been a rather significant point of change for us. Point number 3 pertains to the financial business. The financial business consists of Paid, our B2B settlement business, and Uriho, our B2B accounts receivable guarantee business. Both Paid and Uriho continued showing steady growth. More specifically, transaction value for Paid increased by 11.2% YOY, and Uriho's guarantee balance increased by 21.3% during the same period, with both recording double-digit growth. Although the impact is less pronounced than in the EC business, Paid nevertheless is affected by seasonality factors that make it harder to grow transaction value in the first quarter. In light of this was a rather strong Q1 performance. Another important factor is the cost of sales rate. We will be going over the details in a moment with a graph we have prepared on the topic, but in summary, the cost of sales rate stood at 25.8%, meaning we have a very low cost of sales profile and consequently a very high gross profit margin. The cost of sales rate was down 0.9 percentage points on a YOY basis, and 6.4 points on a QOQ basis. This too was due to seasonal factors and in line with expectations, as the cost of sales rate tends to be lower in the first and second quarters. Lastly, we would like to update stakeholders on progress on the sale of Raccoon Rent, which is our rent guarantee business. We are running slightly behind schedule, as we are in the process of working out a number of minor details pertaining to the sale. That said, Entrust Inc., which is the acquiring party, published a press release this Monday, and negotiations have been proceeding very smoothly. The sale does not cover the entirety of our rent guarantee business, as we'll be transferring part of the guarantee portfolio to NAP Inc., upon which we expect to hand over 100% of Raccoon Rent shares to Entrust Inc., a transaction we expect will take place in November, as announced in the press release. We will incur losses on the liquidation of this business, but, as we have stated previously, the results forecast accounts for this loss, meaning the transfer of ownership will not require a revision to the full-year forecast. Fourth, I would like to address a number of specific factors within the ongoing fiscal year. Allow me to direct your attention to the vertical bar graphs on the left. The top graph shows the trends in advertising and sales promotion expenses by quarter, starting with the fiscal year ending April 2023 and ending with Q1 of the ongoing fiscal year. The graph on the bottom details the trends in operating income by quarter during the same period. As you can see, last year, we posted a normal operating income performance in Q1, which was followed by much lower results in the remaining quarters due to an increase in advertising and promotion expenses. While we are guiding for a YOY increase in operating income of 120% in the fiscal year ending April 2025, there is a degree of variance when it comes to YOY performance for each individual quarter. Operating income was up 7.6% YOY in Q1. Now, I don't believe this is a risk with today's audience, which consists of institutional investors, but we want to make it clear for our retail investor base that a YOY increase of 7.6% in Q1, vis-a-vis a planned full-year operating income growth of 120%, isn't an issue. We believe the graph on page 8 clears any possible misunderstandings by showing the baseline against which the YOY comparison for the ongoing fiscal year was formulated. As such, the operating income target remains unchanged, and furthermore, a YOY increase of 7.6% in Q1 isn't really indicative of an underperformance versus the plan. We normally don't release first-half forecasts, but have done so this year in light of the irregular nature of this fiscal year's YOY comparisons. We are guiding for 3 billion yen in net sales and 580 million yen in operating income by the end of the second quarter. This corresponds to a YOY increase of 77.6% in operating income. This concludes our discussion of the key points. I would now like to proceed to the consolidated results for Q1. We recorded 1.523 billion yen in net sales for a YOY increase of 9.6% and 299 million yen in operating income for a YOY increase of 7.6%. The financial business in particular delivered a very significant growth of 44.7%. Operating income was down slightly in the EC business in the first quarter. Here, we registered very strong GMV results and curbed advertising expenses after having deployed considerable advertising resources in this business last year. We continue doing listing ads, which is the main form of advertising in this business, and as of the end of Q1, operating income was down slightly. Next are the consolidated results excluding advertising and sales promotion expenses. Excluding these expenses, operating income grew 9.5% YOY, as, naturally, this number is higher than the aforementioned figure of 7.6%, which includes advertising and sales promotion expenses. Additionally, excluding these expenses reveals YOY growth in the EC business as well. Next are the trends in group GMV and in the Uriho guarantee balance. As you can see, we are seeing steady growth on both counts. Next is the trend in consolidated sales. Circling back to what I said earlier, consolidated sales have shown very steady growth, rising by 9.6% on a YOY basis. Sales had grown by 9.1% in the fiscal year ended April 2024, so the rate of change in YOY growth itself accelerated slightly to 9.6%. Page 15 shows the trends in net sales by quarter. We normally register a QOQ decline in the first quarter, as was the case last fiscal year, on account of the seasonality factors I discussed earlier. But we broke this trend this year, with Q1 delivering a slight QOQ increase. Next are the trends in gross profit. Gross profit has grown considerably, thanks to an increase in net sales and a lower cost of sales rate for the financial business. Next are the trends in expense composition. This is a YOY comparison with the first quarter of last fiscal year, meaning a baseline before our efforts to enhance promotions. Versus this baseline, there was a YOY increase in listing ads. Additionally, we have raised the expenses baseline to reflect trends in the job market and society in general, and have also hired more people, meaning an increase of 8.4% in personnel expenses. Next are the trends in consolidated operating income. Operating income as of the end of the first quarter stood at 299 million yen, up by just over 20 million yen on a YOY basis, or 7.6%. Operating income excluding advertising and sales promotion expenses would have totaled 543 million yen, corresponding to an operating margin of 35.7%. These represent very robust results. Next are the trends by quarter. As I mentioned earlier, we deployed extensive resources to advertising, such as television commercials, etc., in the second, third, and fourth quarters of last fiscal year, and this led to weaker operating income results. This fiscal year, we have narrowed down our advertising efforts by focusing on the most effective mediums and strategies, so naturally, this has allowed us to achieve a profit recovery. We therefore benefited from this focused strategy in Q1, and also from a revision to the fee structure for super delivery, and operating income is now back to April 2023 fiscal year levels. The number of buying customers has increased significantly, underscoring how we have succeeded in transitioning to a business structure conducive to further growth going forward. We have gone over the numbers shown here on the right as well, with operating income excluding sales and promotional expenses showing a very strong performance. I would now like to give you a summary of the EC business. As I mentioned earlier, the EC business saw a very strong start, with double-digit growth on a YOY basis for both domestic and international GMV. We're guiding for a YOY increase of 13.7% in domestic GMV, with realized results in the first quarter coming in slightly below target at 11.4%. Raising the value of transactions per customer remains an issue, but unfortunately, we didn't see a significant recovery on this front in the first quarter. That said, we recorded very strong buying customer numbers, so while domestic GMV came in around 2% short of the full-year targets, this nevertheless represents robust double-digit growth. Regarding international GMV, we are guiding for a YOY growth of 14.4%, but realized results exceeded this mark by just under 5 percentage points, coming in at 19.2%. We have been carrying out a number of initiatives pertaining to international GMV, such as, for example, measures to strengthen advertising and PR tailored to specific areas, and strengthen cooperation with forwarding companies. In summary, we recorded very strong results in the international segment. I would now like to go over the results in domestic EC. We saw YOY growth across the board in terms of the number of buying customers, with 38% in retailers, 24% in the category of other than retailers, and 31% overall. This is therefore a very significant increase in the number of domestic customers. We started offering a free-of-charge plan last year and strengthened our promotion efforts, and these impressive results in Q1 underscore how deciding to execute these measures really was the right course of action. Conversely, average sales per customer decreased significantly for retailers, and by 3.2% for the category of other than retailers. Overall, average sales per customer in the domestic market were down 15.5%, meaning that this metric unfortunately remains a challenge for us to address. Now, this number has dropped considerably, so we expect average sales per customer to bottom out at some point over the course of the ongoing fiscal year, but unfortunately, we aren't there yet. Next are the results in international EC. International GMV recorded a higher than expected growth rate of 19.2% YOY. Circling back to what I said earlier, YOY GMV growth of 13.3% in Taiwan in particular was key in these results. This market, which accounts for 37% of the overall GMV composition ratio, had seen a YOY contraction last year, so this recovery and double-digit growth drove results in international EC. The US market continued delivering strong results, while Hong Kong continued showing significant negative YOY growth. Investors who attend these results presentations and investors we have held one-on-one meetings with are already familiar with this, but in a nutshell, we are withholding investment in this region due to the fact that we think there are a number of structural issues that don't make Hong Kong an attractive market, at least for the time being. As such, while we don't believe this market has no growth potential at all, the fact remains that we aren't too optimistic about its prospects over the short term, so we haven't really dedicated our efforts to the Hong Kong market. While we do expect GMV to continue declining in this market for a while, its percentage of the overall GMV composition ratio has gone down, so this market's impact in terms of the overall growth percentage has also gone down considerably. Last fiscal year, we released tie-up videos with influencers and YouTubers in the US and South Korea, and these efforts were very successful. In light of this, we continue similar efforts this fiscal year as well, which we have now expanded to other English-speaking countries, such as Great Britain. Additionally, we held an exhibition at a physical venue in Taiwan in April of this year, as a pilot test, and this pilot was a success. Second, we are carrying out measures to strengthen cooperation with forwarding companies, by, for example, expanding functions through API integration and by seeking out forwarding companies we can work together with. More specifically, by working together with these forwarding companies, the idea is for them to refer their overseas customers to us. We only show 4 markets here, but we have recorded positive GMV growth in many other countries and regions. Although the composition ratio for these markets is smaller than, say, South Korea's 9.3%, and is closer to numbers like 3% or 1%. The trends in super delivery GMV are as shown here. As we went over earlier, GMV was up, even on a QOQ basis. Next is the number of buying customers and the value of transactions per customer. The line graph represents the number of retailers over time. We registered a drop in the number of repeat purchasers in the fourth quarter of the fiscal year ended April 2024. As we communicated to stakeholders at the time, this decrease stems from our Welcome Back campaign, which took place in the second and third quarters, and which was a campaign designed to attract dormant or inactive customers. A certain percentage of these customers stopped shopping after the campaign was over, and hence the decrease in repeat purchasers. And we stressed the fact that this was merely a one-off phenomenon and therefore not a cause for concern. Since then, we have seen a strong recovery in repeat purchasers in the first quarter, in line with company forecasts. We also registered a rather strong performance in terms of first-time purchasers as well. In other words, we are currently benefiting from what might be characterized as the ideal customer pipeline, that is, a steady influx of new people who then become repeat customers. On the other hand, unfortunately, we are yet to see a reversal of this downward trend in value of transactions per customer. The line with the white dots shows the value of transactions per customer in the international segment, which increased slightly in the first quarter. Additionally, transaction value per customer for other than domestic retailers was down slightly, and therefore remained mostly flat. Lastly, while this metric increased for domestic retailers in the fourth quarter, unfortunately, it came back down again in the first quarter. That said, we have access to more granular data, which underscores a degree of variance from one month to the next, with some months doing well and others performing worse. In other words, this is no longer a uniform downward trend, so we suspect we're getting closer and closer to an inflection point. we have already covered the trends in sales by quarter. In terms of the trends in segment profit by quarter, we allocated resources to the airing of television commercials in the second, third, and, to a limited extent, in the fourth quarter last year, and these expenses led to a significant drop in segment profit. The only YOY increase in advertising expenses in Q1 was in listing ads, and this has translated into a profit recovery, although, to be precise, segment profit remained marginally below Q1 levels last fiscal year. Excluding advertising and sales promotion expenses, segment profit was up on a YOY basis. We leveraged television commercials last fiscal year within the scope of the EC business, but while these did indeed produce results, it became apparent that the medium of television requires a medium to long-term approach due to the short-term drag on profits. As such, we have opted for a growth strategy focusing on increasing the amounts deployed in listing ads. Increasing our listing ad spend, that is, raising the SG&A baseline, has allowed for a return to previous profit levels. We don't have plans to continue further expanding our advertising spend, so we will now be entering a phase characterized by this structure allowing us to capture profits corresponding to any further growth in GMV. The EC business boasts gross margins corresponding to around 80% of sales, so we expect further increases in GMV to translate into a corresponding increase in profits. I believe that the metric of value of transactions per customer remains a concern for many stakeholders, but once things start stabilizing on this front, we will be able to capture this upside as well. Next is the summary for the financial business. Transaction volume for paid was up 11.2% YOY, while Uriho's guarantee balance grew by 21.3% during the same period. Both business segments therefore continued delivering strong growth. Regarding paid, we have expanded potential solution areas for proposals. As previously disclosed, we have entered a business partnership with Pailed Inc., which is a startup credit card provider to corporate clients and not affiliated with Paid itself, despite the similarity in the name. Through this partnership, we offer coverage through Paid of the existing credit limit provided by Pailed Inc. In other words, we assume this credit card risk. We expect to see similar promising partnerships in the future as companies approach us and we seek opportunities by approaching companies ourselves. Regarding Uriho, it's a target-rich landscape, so we are carrying out target-specific enhancement measures. An example of this is the guarantee of factoring loans, as we are taking a proactive approach to securing partnerships and projects outside the regular scope of Uriho's business. The trends in paid transaction value are as shown here. In Q3 of last year, we registered a QOQ decrease in transactions outside the group, when some large member companies discontinued the use of paid. We have since then staged a recovery in Q4 and now in Q1 of the ongoing fiscal year as well, as it pertains to these external transactions. In fact, several of the companies that had discontinued the use of paid in Q3 of last year have since then resumed their use of our service, so this played a role in the recovery. Next is Uriho's guarantee balance. The results are as shown here on page 33. While we saw rather subdued QOQ growth between Q4 and Q1 of this year, the growth rate for the guarantee balance nevertheless remains in the double digits. We continued delivering growth across the various KPIs, and this has translated into growth in sales by quarter. The results are as shown here on page 34. This is a key graph showing the trends in cost of sales rate by quarter. We more or less equate this with default risk levels, since defaults account for the majority of costs in the financial business. Circling back to what I said earlier, the cost of sales rate is affected by seasonality factors. Looking at pre-pandemic levels, one can discern a rising progression starting with Q1 and ending with Q4. In other words, default rates would rise throughout the fiscal year and then drop at once in Q1 of the following year. This general trend was broken during the pandemic years, that is, 2021 and 2022, on account of aid programs carried out by the Japanese government. but this was a temporary anomaly stemming from the response to the virus, and thus isn't representative. Starting last year, we are now seeing a return to the previous recurring pattern of a rising cost of sales rate toward the second half of the fiscal year, followed by a decrease in Q1 of the following year and relatively low default levels in Q2. A reason for concern here would be if the cost of sales rate didn't drop in Q1 after increasing in the second half of the previous fiscal year. But since it has indeed dropped, this means that results so far have been in line with company expectations and with previous years. We therefore believe this underscores the degree to which we have been able to skillfully manage default rates. Last are the trends in segment profit by quarter within the financial business. Operating income dropped precipitously in the fourth quarter of last fiscal year on account of, as shown here in the graph on the right, a significant deployment of advertising expenses in the form of the airing of television commercials. Operating income then rebounded in the first quarter, although it would perhaps be an exaggeration to say this was the result of the commercials we aired. We staged a very significant operating income increase in Q1 thanks to higher sales. As is the case with the EC business, the financial business boasts very high profit margins, with a cost of sales rate of only 25%. This means that we capture 75% of an increase in sales as gross profit. We expect something similar for the EC business, which could potentially benefit from higher GMV translating into higher gross profit. Looking at the graph on the right, operating income excluding advertising and sales promotion expenses stood at 240 million yen, which is a very strong result. This concludes my review of the presentation materials. Last, allow me to give you a bit more information on the company's capital policy for the ongoing fiscal year. This is essentially a reiteration of what we already went over in the results presentation back in June, but in summary, a proposal was approved at the company's shareholders' meeting to reduce legal capital reserves, freeing up around 1.2 billion yen and therefore significantly increasing the amount available for distribution. Back in June, I mentioned how Raccoon takes a proactive approach toward the execution of share repurchases. We haven't announced any share repurchases, but I would like to use this opportunity here today to reiterate that our policy and approach to the topic remain the same. This concludes today's presentation.